Bitcoin just ripped through another all-time high. In fact, we're in the phase of the bull market where Bitcoin rips through several all-time highs per week. Over the weekend, Bitcoin surged over 5%, jumping from 119K to over $125,000. And we're currently in the phase with Bitcoin's bull market where we hit several new all-time highs every week. It's up more than 14% in the past week. For reference, it took 40 days for gold to do the same. Bitcoin is trying to catch up with gold earnestly at this point in time. The last time that we saw a momentum like this was last November when Bitcoin exploded 35% through the end of the year after that dam of ambivalence broke following the Trump election and over 5 months of consolidation. So what happened and why did it happen? What does it signal and how should we think about it heading into Q4? Well, first things first, what I'll say is that the week is off to a strong start, and that's a very good sign for BTC. Over the weekend, generally do not trust price action. Bitcoin can dump on a Sunday night, it can pump on a Friday night, but really the tell is what happens on Monday. And given the fact that Monday is off to a great start, it should be a good week. But for nearly 4 months, Bitcoin consolidated between $95,000 and $115,000, which is a very tight range that built up enormous pressure. Long-term holders use that range to take profits, distributing coins to new market entrants. And now those zones of selling have largely been fully absorbed. We're encountering some more resistance now that we're at $125,000 as holdouts from people who purchased at the prior all-time high are now selling at a slight profit. So once buyers have fully absorbed all that selling pressure, Bitcoin is broken out of its summer range with force. We've already seen it again. Bitcoin is up 15% this week. And this pattern mirrors what we saw last September and October when months of sideways price action turned into vertical price discovery into the end of the year. Historically, Q4 is Bitcoin's strongest quarter, as I've mentioned before, and we're right on schedule. Already, the month of October has outperformed the entirety of the month of September, and we've almost outperformed last year's October. So who's behind the buying this time around? It's institutions, namely, not retail investors chasing momentum, as was the case in prior cycles, but of course, ETFs accumulating for their clients. The structural bid from passive flows are increasing as the weeks go by. Hedge funds are obviously rotating into asymmetry as well as they believe Bitcoin is now playing the catch-up trade to gold, and of course, corporations expanding their Bitcoin treasuries. They're all seeing the exact same thing, and that is Bitcoin is cheap relative to other assets currently in the market, namely gold. And the macro environment is screaming for not just high risk, high beta exposure, but also hard money exposure, as we saw with gold earlier this summer. The Fed, just like last year, is cutting rates into rising risk asset prices and only amplifying that bid. Every time yields fall, the cost of capital declines, so capital moves out on the risk curve seeking a better return, first into equities and now increasingly into an even higher beta play like Bitcoin. This is the high beta hard money trade, essentially. Bitcoin acting as both a tech asset and a monetary hedge, and it's happening against a backdrop of something even bigger, something that gold sniffed out this summer, which is the debasement trade. Since 2020, as you can see here, the NASDAQ has risen 181% in dollar terms, but in gold terms, it's up only 9%, and in Bitcoin terms, it's down 84%. You can see the exact same story playing out in US houses, up 56% in dollars, down 25% in gold, and down over 90% in Bitcoin. That's what monetary debasement looks like. Everything nominally goes up, but only hard assets preserve real value. President Trump even said the quiet part out loud, something that I've been hammering for 4 years straight since I began in this industry, which is that the US is going to try to grow its way out of the debt problem. In practice, that means running wide deficits and printing enough money to outgrow the debt in nominal terms, effectively inflating it away. The government has essentially given up on restraining inflation, naming 3% as its new long-run target. It's now clearly embracing it because it's the easiest way to manage our $37 trillion debt load. That strategy will work politically, but not economically, because it drives capital into scarce assets like Bitcoin and gold that can't be printed. So what does it all mean? In the short term, Bitcoin looks poised, of course, as I mentioned earlier in the show, to chase 135K and 150K as capital rotates back into risk assets through the end of the year. But in the long term, it's also the clearest beneficiary of a regime defined by artificially low rates and permanently high inflation. So Bitcoin is completely repricing into this new world. If you haven't positioned for that yet, as the broader market seems to be doing, now is the time to start thinking seriously about it. That's all for today's video. Thank you so much for watching. If you enjoyed, make sure to like and of course reshare so more people can see this and follow for more, and check out Horizon. Obviously, Bitcoin is having a banner Q4, and if you want to get in on that, Horizon may have a solution for you. Horizon lets you buy Bitcoin using your home equity without new debt, monthly payments, interest charges, or term limits. You can check that out at joinhorizon.com or by scanning the QR code right there. That's all for today's video. Thanks again for watching. I'll talk to you soon.